Looking for great stocks in 2025? I have 5 stocks that I think are great buys right now. I'm going to give you the details on each one, why their financials are attractive, why they're a good valuation. Remember, the market is very highly valued right now. So I think investors want to look for good value stocks. These stocks have a nice combination of growth and value. So that's what I'm going to dig into today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with the stock that I have been buying the most over the past 6 months or so. That is Alphabet. Alphabet has a number of things going for it. Let's start with the core business. The core business is actually doing well right now. They have come out of the doldrums of ATT. That's Apple's app tracking transparency. That's where the tie between basically clicking on an ad on your phone and knowing whether that ad was effective for the advertiser was broken by Apple. That tracking was broken. And so companies had to figure out a way around that. And they have done that with Google leading the way. You can see that revenue has started to grow again in their core search business and their Google network. Those two basically combined to be the most of their advertising business. So despite the fact that we're hearing a lot that artificial intelligence is going to be a disruption to Google and to Alphabet, that's not really playing out in the numbers. On top of that, you have similar trends at YouTube. YouTube ads continue to grow, and the company recently said that the entire YouTube business, so including premium, is exceeding $50 billion in revenue. That is bigger than Netflix is today. I think that's really underappreciated in the market. The fact that YouTube doesn't have to build their own content, that they don't have to do these massive deals that other media companies do and streaming companies do. They have content creators like me providing content to them. They just need to serve advertisements. That's what helps content creators monetize. It's also what helps the platform monetize. So that platform is extremely strong and extremely profitable for Alphabet. An underappreciated piece of the business is hardware subscriptions and platforms. This is where the Pixel phone is going to fall. This is where Gmail subscriptions are going to fall. This is where a lot of their artificial intelligence growth, I think, is really going to materialize. If you think that something like Gemini is a differentiator for Android phones versus something like the iPhone, this is where you're going to see that growth. And I think there's a lot of evidence that Android phones are really well positioned for artificial intelligence in a mobile world. On top of that, you have the Google Cloud. That is where there is tremendous growth. And Google is basically the one company that is not beholden to NVIDIA in artificial intelligence. They have their own TPU chips. So that gives them a point of differentiation, also gives them a little bit more margin. And they're starting to leverage that. This is a business that's now growing 30% per year. And it's now profitable. Just reach that profitability point. We're just getting past about 10% operating margins. That could exceed 20, maybe even 30% long term. So I think you add all of these pieces together, and Alphabet is a very well-positioned company, and the price is right for investors. As I'm recording, shares are trading for 26 times trailing earnings and just 23 times forward earnings. This is a company that's growing in double digits. It's one of the leading tech companies in the world. It's not going anywhere. Even the antitrust threats that have threatened the company may unlock more value for Alphabet investors than it destroys. There's a lot of things that I haven't talked about here too that could add value in the future. Things like Waymo, all of their other bets. There's a lot to like about Alphabet. And I think the price is just too good to pass up for investors right now. The second one is one I've been pounding the table about for some time. That is MGM Resorts. This is a company that operates primarily in 2 locations, the Las Vegas Strip and Macau. So think about this as entertainment hubs. People continue to go to these hubs, spend money on hotel rooms, restaurants, entertainment, and also gambling. The thing about these hubs is they are a draw for people, and there's no new addition of supply. It's very limited, not only the geographic space in the Las Vegas Strip, which MGM basically owns half of the Las Vegas Strip, but also it's very expensive to build new casinos. So there's not much new supply that's coming to the market in Macau. That supply is even more limited. The government even limits the number of tables and slot machines that companies can have. So the profits and the revenue that the company has coming from those 2 regions are very, very well protected. On top of that, you have growth optionality in online gaming, not only in the US, but also in Europe, and they're launching in Brazil. And you have a new casino coming in Japan. This is going to be the only casino that's going to be built in Japan. MGM owns 40% of it. That will open in 2030. That could be the most profitable casino and resort in the world when it opens up. I think that's really underappreciated. And on top of all of this, investors get to buy this company with a 15% buyback yield. Management is basically using all of the cash that they're generating for the business because they already have excess cash on the balance sheet. They have very little debt, very manageable level of debt. So they're using the excess cash that's being generated by the business to buy back shares. They're buying back about 15% of their shares outstanding. That was actually before the recent stock drop. So they might be buying back more than 15% of shares on an ongoing basis starting in the fourth quarter of 2024. So you get great value, growth optionality, and at worst, the company is going to buy back stock at a really rapid rate. I think that's a great reason to love MGM Resorts stock today. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The third stock is one that's gone through a lot of tumultuous times over the past couple of years. That is Disney, but I think Disney is a very good position today. The foundation of the company is really not what it used to be. It's not the cable business, not the studios. It's actually the parks. The parks are a cash flow machine generating nearly $10 billion in operating income from the parks alone. That is going to grow over time because they're investing about $60 billion in expanding parks and cruise lines. Very attractive business that really only Disney has in the media business. But the other thing is the company is really focusing on the studios and then building out the streaming business. And I think those studios are starting to perform better and better. That's evidence at the box office. And the streaming business is very underappreciated by the market. Streaming just got to profitability in the last quarter or two, but that is going to improve in 2025 as not only price increases go through, but cost cuts start to take effect, bundling starts to take hold, and later this year, in the fall of 2025, ESPN is going to be going over the top. That, I think, is going to be the linchpin to the company's streaming strategy. They're going to have a ton of content, everything from the NFL to NCAA football. Those are the most popular pieces of content. They also have the NBA. That's going to draw millions and millions of subscribers to that bundle. And ESPN itself may cost $20 or $30 per month. This is going to be a huge revenue generator and I think drive profitability and revenue growth for Disney. And investors are getting this at a pretty good valuation. Price earnings multiple on a forward basis is under 20. And remember, that's going to be before the ESPN impact really hits the income statement starting in 2026. So Disney hasn't been a very loved stock by the market, but I think the foundation of experiences, the improvement in the studios, and then the streaming business, which is in a much better position than I think a lot of investors think. Yes, it is behind Netflix, but it's only behind Netflix on the media side of the streaming business. It's far ahead of companies like Paramount, Warner Brothers Discovery, and Peacock. I think it's in a very good position to be a leader in streaming long term. Number 4 is Robinhood. Robinhood I talk a lot about on this channel, but this is one of the fastest growing companies in financial services, in brokerages. The company is now profitable, so it's growing the number of assets that it has on the platform. The amount of deposits continue to grow. They are attracting customers with their gold subscription. I think this is one of the things that really differentiates Robinhood. They have a different business model than most of their competitors. Gold subscribers pay a monthly or annual fee, and what they get for that is higher interest rates on their deposits. You can get a credit card with 3% cash back. There are better terms for margins. Basically, it's just a magnet for the company to attract subscribers. And remember, that subscription fee is all profit. Think about this a little bit like the Costco model. Costco can make money on their subscriptions and then run the rest of the business at a break-even basis because they don't have to be beholden to the same economics as other big box retailers. Robinhood is playing out a similar playbook in the brokerage business, and they have a ton of tailwinds behind them. They are only now starting to really expand internationally. There's a ton of different asset classes and account types that they can expand into, everything from joint accounts to student accounts and custodial accounts. They haven't moved into the employee-backed market yet. So I think there's multiple decades of growth ahead for Robinhood. This is one of those stocks that I'm going to be acquiring for the next few years and just riding it until it becomes a much more mature company, maybe 10, 20, 30 years from now. And the final one is a little bit more of a contrarian play, and that is Lyft. Lyft is a smaller competitor to Uber, but it's very attractively priced, and the economics for the business are getting better and better. They are now free cash flow positive. The enterprise value to sales multiple is just 0.9 at this point. And I think autonomy really changes the game for Lyft. The problem Lyft has always had in the ride-sharing business is they didn't have as much supply as Uber. And if you don't have as much supply, you're not going to be able to attract demand. This is a two-sided market. It's a tenuous two-sided market, but it is a two-sided market, and Uber has been able to control that supply for over a decade now. But Lyft could change that dynamic as they continue to go more and more all in on autonomous driving. They have a number of partnerships. They're going to be rolling that out in 2025. I think this is a place where Lyft could really lean into increasing that supply in a number of markets in 2025 and 2026 with fully autonomous vehicles. That could help them lower their cost structure. It could help them level the playing field with Uber. That is pure upside for Lyft. So I think that's why this is a very attractively positioned company. They're growing a number of different partnerships with DoorDash. They have a deal with Mobileye, so basically Mobileye vehicles, which is going to be Volkswagen vehicles. So about 9 million of those made worldwide each year. Those are going to come Lyft ready. So think about that like a robo-taxi, except it's going to be the Lyft network. So a already established network for millions of vehicles on the road each year. Lots of upside potential for Lyft. And I think this is arguably a very good value stock today. So that's why Lyft is one of my top stocks for 2025. So let's go through this list again. Alphabet, MGM Resorts, Disney, Robinhood, and Lyft. Tell me which one of those stocks is your favorite in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.